Welcome back to Morning Trade Live. It's time to go inside out on streaming stocks. Seth Schachner is with us, Managing Director, Strat Americas. Glad you're here with us today. We're looking at Warner Brothers. They came out with their earnings, and really the box office hasn't been particularly great for a name like Warner Brothers. You also have what's going on with the Trump tariff possibilities on some of these foreign films that are made in foreign lands. So let's talk about Warner Brothers first.
Sure. I mean, good to be here, Nicole. I think some of this is timing because, I mean, right now in the current landscape, Warner has like two of the hottest pictures, right? It's got Sinners and it's got Minecraft, and I don't know if that's been reflected in these results that we're talking about. So just, sometimes entertainment products like films, the releasing schedule isn't as cyclical or predictable as people would like, and you sometimes see that in the results. But yeah, streaming slowed down a little bit. There's a bit of that's showing up. And, the big news out here in LA, where I'm based, is just this question of tariffs, which has kind of morphed into a discussion around tax incentives. And so it actually looks like it's going to wind up being a more positive, discussion for the business where there may be some form of a federal tax credit, which would make it a lot more, competitive and positive of a thing for our filmmakers and our production facilities. But kind of the news came out around tariffs first and foremost, which I think scared a lot of people. So it sounds a little mixed, but, from my perspective, I've been very positive, lately on Hollywood summer, and in particular, Warner Brothers.
So I'm watching Warner Brothers this morning because I had put it in my notes that it was one of the losers on the S&P 500. In fact, it was down around 4% right after the opening bell rang. I made that note in my notebook. If you look at Warner Brothers Discovery now, you see it up 1%. So this intraday move is pretty sizable here, right? You're talking about 5% swing here. And it's been reported by another network that Warner Brothers may be spinning off parts. Or is there anything you can speculate on why we would see such a big fast change here on Warner Brothers stock? And one day, what's the possibility if they start to see the value of the parts? What would be the most valuable of the parts?
I mean, the market kind of reacted pretty heavily when President Trump made that kind of very quick announcement without really speaking to it. I think he was flying home on Sunday night. So a lot of the media stocks were down, on the idea that they're going to start getting hit by these crazy production tariffs, if you will, which just because of the way Hollywood's aligned would be, I think, very, very difficult for a lot of companies that would impact everything from Netflix to studios, basically. But I think it was clarified the next day. Things kind of, immediately recovered, if you will. And so I think you're seeing some of the rebound around that. But I mean, the valuable parts, I think, clearly are streaming is what the street has been looking at. And that has been about how fast can you grow it, but it's now about how profitable can it be. And I think from time to time, you're going to see, growth will slow a little bit in terms of subscribers because of all of the different competitive services that are out there. And that's probably why you're seeing that a little bit right now. But I think streaming is probably what everyone's looking at. I look at motion pictures. I look at other things. If it was a more robust, diverse company, say like a Disney, you look at things like parks and things that are just beyond a little bit pure streaming. So it's a mixed picture for sure.
Yeah. All right. So folks, I mean, look at this chart. It sort of shows the move we're seeing. Now it's at 874. It was up 3% after having been down 4% what feels like just moments ago. So big move here for Warner Brothers Discovery today. Let's talk about some of the other names. What else is in focus for you when you think about these streamers? Which names may be most affected by tariffs or consumers being more chintzy? They don't want to spend too much.
Well, the biggest news right now, is always around Netflix and what they're doing. And so, the big thing there is this new interface they're bringing in, basically, which looks like it's super cool. It's got AI in it. It's going to let you discover things that are buried in there that you may not know that's even in there, which I think is super cool. And it should actually communicate or bring about some social aspects to it as well. So I think that's extremely, the most positive thing I'm following in the streaming space right now. I mean, the other thing that's here is just if NBC, Warner Brothers start spinning off some of their pay TV networks and merge them. And I think people have their eye on that as well.
So, I mean, right now, do you think that Netflix is still the best of the bunch? I mean, would you say Netflix is the dominant name?
Unquestionably. I mean, they're out ahead of everyone. They're doing everything possible to keep that lead. So to me, they're still very much the leader. No one's even close.
And then what would you say is second place, third place? I mean, if you think there's continued growth and opportunity for these names.
I think Prime is really, really strong for sure. They have great engagement. So that's one that I think is really important. And then I think, if you start looking down the lot a little bit, Max is out there as well. Peacock as well is probably a second or third place or fourth place as well.
Wow. Wait, Amazon Prime and Peacock, is that what you said?
Yeah, I think they're the next tier down. I don't know if they're purely third, but I think Prime has had really great engagement with customers, actually.
It's very easy to use. It's very easy. For example, I'll use myself for some color. I have old school cable because I can give you 1,000 reasons why I love it. But I do have Amazon Prime because I have to ship packages regularly. With that comes along this opportunity to watch videos. And it's very easy to navigate and watch things. I do not have Netflix. I do not have Disney Plus or any of the others. So it shows you that there's a certain demographic, like myself, that they're hitting, right?
Yeah, I think the thing with Prime is there's just a huge, big, broad amount of content that they have. And they're just a tremendous aggregator of it. And that's what their strength is. I think Netflix has got such robust niches in there, lots of international content, and that's why they're sort of, in the leader's seat. They've got a little bit of content for everyone, actually.
When we talk about deals, you think about, we were just speaking moments ago about spinning off some of the pay TV things, Warner Brothers, we said maybe splitting up parts, etc. Do we need more sort of consolidation or focus in this way? Because, spending on original content like Netflix does, for example, is we always used to hear the billions of dollars they're spending on content, right? Can they sort of streamline that?
I think consolidation is going to be really important because I don't think consumers need, all these different choices. So yeah, I think that's going to be something that's been talked about perennially the last 3 years since the streaming wars kind of started. But yeah, I think that'll be a logical thing that you'll see, honestly. Absolutely. I think, whether it's Max combining with Paramount Plus, or some of the others for sure. I think Peacock, Paramount Plus, and Max are probably the likeliest candidates for that.
Yeah, and once again, you said the key Warner Brothers movies. I heard you mention Minecraft movie and Sinners too. Seth Schachner, thank you so much. It's great to see you, Managing Director of Strat America. It's nice to see you, Seth. Thank you. So Tom White is here, host of Fast Market, taking a look at Netflix, which he just said it was undeniably the behemoth, the leader of the bunch. And you have a couple of example trades for us this morning, Tom. You begin with a neutral to bullish trade.
Yeah, Nicole, not surprised. The stock's hit an all-time high in today's session above 1164, pulling back here a little bit on this overall market pullback. But, the momentum's still to the upside, right? It's one of those subscriptions nobody's given up. So first strategy I looked at was a little bit neutral to bullish, where you don't have to be aggressive on a bullish trade because the stock is overbought. The RSI is above the 70 level at this point, so maybe you don't want to do something more aggressive to the upside. So I looked at a short neutral to bullish put vertical where I can sell something out of the money to the downside, still profit if it goes up, if it stays where it is, or goes lower but remains above my break even. Looking at selling the 1120 strike put out in the May 30th weekly cycle. So you've got 22 days to expiration, so just about 3 weeks. Sell the 1120 strike put and then buy the 1100 strike put. So a short $20 wide neutral to bullish put vertical. You're collecting roughly about a $550 credit on that. That's what you can make, $550 with $1,450 in risk on this trade. But it takes your break even all the way down to $1114.50 to the downside. So you've got that cushion of over 3% to the downside before you start getting hurt on a trade like this. So a little bit more conservative, but giving yourself a better probability of success after this massive run-up of 30% that we've seen in Netflix so far this year.
Understood. And then you also have, and that's still May 30th, you have a more bearish example trade as well, as this stock, as you mentioned, hit all-time highs.
Yeah, it's not extremely bearish. You're still giving yourself a cushion to the upside, but kind of flip-flopping it, where I went to the call side, and I went out to the May 23rd weekly cycle. So just 15 days to expiration on this one, a little bit shorter in duration. If you think maybe this rally's run out of steam, as the stock's kind of around the flat line here today. But it still gives you some room to the upside for the stock to continue to move up where you won't get hurt on this trade. So I looked at an unbalanced or broken wing call butterfly to the upside, where actually I'm going to take a credit in when upon initiation. So going out to that May 23rd weekly cycle, we're going to buy one of the 1,200 strike calls that's out of the money to the upside, nearly $50. Buy one of the 1,200 strike calls, sell two of the 1,205 strike calls, and then buy one of the 1,240 strike calls. So in essence, you're buying a bullish $5 wide call vertical, but then offsetting some of the costs, a lot of the costs, by selling the 1,205, 1,240 call vertical. That comprises this butterfly with the same common strike at the 1,205 level. You're going to collect a credit of about 650. It might be a little bit lower than that right now. The stock has pulled back. But the credit that you collect is what you can make on it, and that's anywhere below 1,200. You just get to keep the credit that you collect. Now, if I collect 650 credit on it, it takes my break even all the way up to 1216.50 over the next 2 weeks. That's over 5% above the current share price in there. So like the short put vertical, where I profit in 3 out of 4 scenarios, same thing goes here. If the stock goes lower, stays where it is, or even goes a little bit higher but remains below that 1216.50 break even, you can be profitable on this. All the losses on this type of trade is if this stock continues to move to the upside and goes above that break even. Max loss is above that 1240 line at this point, but it still gives you a little bit of cushion where the stock can still run to the upside and you can still be profitable on this one.
Okay, Tom White, great to see you. Thank you for that look at Netflix and 2 example trades for us. Appreciate it.